In this chapter, we revisit accounting changes and error correction to synthesize the way these are handled in a variety of situations that might be encountered in practice. We see that most changes in accounting principle are reported retrospectively. Changes in estimates are accounted for prospectively. A change in depreciation methods is considered a change in estimate resulting from a change in principle. Both changes in reporting entities and the correction and errors are reported retrospectively. You learned early in your study of accounting that the two of the qualitative characteristics of accounting information that continue to its relevance and representational faithfulness are consistency and comparability. Though we strive to achieve and maintain these financial reporting attributes, we cannot ignore the forces of change. Ours is a dynamic business environment. The economy is increasingly a global one. Technological advances consistently transform both day-to-day operations and the flow of information about those operations. The accounting professor's response to the fluid environment often means issuing new standards that require companies to change accounting methods. Often, developments within an industry or the economy will prompt a company to voluntarily switch methods of accounting or to revise its estimates or expectations. In short, change is inevitable. The question then becomes a matter of how best to address change when reporting financial information from year to year. In the first part of this chapter, we differentiate among the various types of accounting changes that businesses with a focus on the most meaningful and least disruptive ways to report those changes. Then, in the second part of the chapter, we direct our attention to a closely related circumstance, the correction of errors. Accounting changes fall into one of three categories: change in accounting principle, change in accounting estimate, or change in reporting entity. The correction of an error is another adjustment sometimes made to financial statements that is not actually an accounting change, but is accounted for similarly. Errors occur when transactions are either recorded incorrectly or not recorded at all, as shown in this illustration. Depending on the situation, two approaches are used to report accounting changes and error corrections. The retrospective approach. Using this approach, financial statements issued in previous years are revised to reflect the impact of the change whenever those statements are presented again for comparative purposes. An advantage of this approach is that it achieves comparability among financial statements. All financial statements presented are prepared on the same basis. However, some argue that the public confidence and integrity of financial data suffers when numbers previously reported as correct are later superseded. On the other hand, proponents argue that the opposite, that is, impossible to maintain public confidence unless the financial statements are comparable. For each year reported in the comparative statements, the balance of each account is revised. In other words, these statements are made to appear as if the newly adopted accounting method had been applied all along, or that the error had never occurred. Then a journal entry is created to adjust all the account balances affected to what those amounts would have been. In addition, if retained earnings is one of the accounts that requires adjustment, the adjustment is made to the beginning balance of the retained earnings for the earliest period reported in the comparative statements of shareholders' equity. The retrospective approach offers consistency and comparability. The prospective approach. This approach requires neither modification of prior year's financial statements nor a journal entry to adjust account balances. Instead, the change is simply implemented now, and effects are reflected in the financial statements of the current and future years only. The effects of change are reflected in the financial statements of only the current and future years under the prospective approach. Accounting is not an exact science. Professional judgment is required to apply a set of principles, concepts, and objectives to specific sets of circumstances. This means choices must be made. In your study of accounting to date, you've encountered many areas where choices are necessary. For example, management must choose whether to use accelerated or straight-line depreciation. Is FIFO, LIFO, average cost method, the appropriate measure of inventories? Should we adopt a new accounting standard early or wait until it is mandatory? These are but a few of the accounting choices management makes. You are also probably recall that comparability is an enhancing qualitative characteristic of financial reporting. To achieve this attribute of information, accounting choices, once made, should be consistently followed from year to year. This doesn't mean, though, that methods can never be changed. Changing circumstances might make a new method more appropriate. A change in economic conditions, for instance, might prompt a company to change accounting methods. The most extensive voluntary accounting change ever, a switch by hundreds of companies from FIFO to LIFO in the mid-1970s, for example, was a result of heightened inflation. Changes with specific industry, too, can lead to a company to switch methods, often to adapt to a new technology or to be consistent with others in the industry. And of course, a change might be mandated when the FASB codifies a new accounting standard. For these reasons, it is not uncommon for a company to switch from one accounting method to another. This is called change in accounting principle. Although consistency and comparability are desirable, changing to a new method sometimes is appropriate. It would be nice to think that all accounting choices made by management in the best interest of fair and consistent financial reporting. Unfortunately, other motives influence the choices among accounting methods and whether to change methods. It has been suggested that the effect of choices on management compensation or existing debt agreements and on union negotiations can affect management's selection of accounting methods. For instance, research has suggested that managers of companies with bonus plans are more likely to choose accounting methods that maximize the bonuses, often those that increase net income. A financial analyst must be aware that different accounting methods by different firms and by the same firm in different years complicate comparisons. Financial ratios, for example, will differ when different accounting methods are used, even when there is no difference in the attributes being compared. Investors and creditors should be alert to instances in which companies change accounting methods. They must consider not only the effect on comparability, but also the possible hidden motivation for making the changes. Are managers trying to compensate for a downturn in actual performance with a switch of methods that artificially inflate reported earnings? Is the firm in danger of violating debt covenants or other contractual agreements regarding financial position? Are executive compensation plans tied to reporting performance measures? Fortunately, the nature and effect of changes are reported in the financial statements. Although a justification for a change is provided by management, analysts should be wary of accepting the reported justification at face value without considering a possible hidden agenda. It would be nice to think It would be nice to think that all accounting choices are made by management in the best and fair, consistent reporting. Unfortunately, other motives influence the choices among accounting methods, whether to change methods. It has been suggested that the effect of choices on management compensation, on existing debt agreements, and on union negotiations can affect management's selection of accounting methods. For instance, research has suggested that managers of companies with bonus plans are more likely to choose accounting methods that maximize the bonuses. Often those increase net income. Other research has indicated the existence and nature of debt agreements and other aspects of a firm's capital structure on influencing accounting choices. Whether a company is forbidden for paying a dividend, is retained earnings fall below a certain level, for example, can affect the choice of accounting methods. A financial analyst must be aware that the different accounting methods used by different firms and by the same firm in different years complicate comparisons. Financial ratios, for example, will differ when different accounting methods are used, even when there are no difference in the attributes being compared. Investors and creditors should also be alert to instances in which companies change accounting methods. They must consider not only the effect on comparability, but the possible hidden motivations for making the changes. Are managers trying to compensate for a downturn in actual performance with a switch to methods that artificially inflate reported earnings? Is the firm in danger of violating debt covenants or other contractual agreements regarding financial position? Are executive compensation plans tied to reported performance measures? Fortunately, the nature and effect of changes are reported in financial statements. Although a justification for a change is provided by management, analysts should be wary of accepting the reported justification at face value without considering possible hidden agenda. Choices are not always those that tend to increase income. As we have learned in Chapter 8, many companies use the LIFO inventory method because it reduces income and therefore reduces the amount of income taxes that must be paid currently. Also, some very large and visible companies might be reluctant to report high income that might render them vulnerable to union demands, government regulations, or higher taxes. Another reason managers sometimes choose accounting methods that don't necessarily increase earnings was mentioned earlier. Most managers tend to prefer to report earnings that follow a regular, smooth trend from year to year. The desire to smooth earnings means that any attempt to manipulate earnings by choosing accounting methods is not always in the direction of higher income. Instead, the choice might be to avoid irregular earnings, particularly those with wide variations from year to year, a pattern that might be interpreted by analysts as denoting a risky situation. Obviously, anytime managers make accounting choices for any of the reasons discussed here, when the motivation is an objective other than to provide useful information, earnings quality suffers. As mentioned frequently throughout the text, earnings quality refers to the ability of reported earnings, the income, to predict a company's future earnings. We report most voluntary changes in accounting principles retrospectively. This means that reporting all previous periods' financial statements as if the new method had been used in all prior years. An example is provided in the illustration. Airparts Corporation used the LIFO inventory costing method. At the beginning of 2016, Airparts decided to change to the FIFO method. Income components for 2016 and prior years are given in the illustration. LIFO usually produces higher cost of goods sold than does FIFO because more recently purchased goods, usually higher priced, are assumed sold first. We now see how the company recasts the comparative statements for each year reported in the comparative statements. Airparts makes those statements appear as if the newly adopted accounting method, FIFO, had been applied all along. As you learned in Chapter 1, comparability is one of the important qualitative characteristics of accounting information. When accounting changes occur, the usefulness of the comparative financial statements is enhanced with retrospective applications of those changes. Earnings per share each year, of course, will be based on the revised net income numbers. The company recasts the comparative financial statements to appear as if accounting method adopted in 2016 had been used in 2015 and 2014 as well. Balance sheets. Inventory is a comparative balance sheets. Airparts will report 2016 inventory by its newly adopted method, FIFO, and also will revise the amounts it reported last year for its 2015 and 14 inventory. Each year, inventory will be higher than it would have been used by LIFO. Here's why. Since the cost of goods available for sale each period is the sum of the cost of goods sold and the cost of goods unsold inventory, a difference in cost of goods sold resulting from having used LIFO rather than FIFO means there is also an opposite difference in inventory, because cost of goods sold by the FIFO method is less than LIFO. Inventory by LIFO is greater than LIFO. The amounts and the differences also contains the cumulative differences over the years calculated in the illustration. Retained earnings. Similarly, Air Parts reports retained earnings by FIFO each year as well. Retained earnings is different because the two inventory methods affect income differently. Because cost of goods sold by FIFO is less than by LIFO income, and therefore retained earnings simply is earnings by FIFO are greater than LIFO. Comparative balance sheets then will report retained earnings for 2016, 2015, and 2014 at the amounts of $276, $240, and $207 million higher than would have been reported if the switch from LIFO had not occurred. These are the cumulative net effect differences shown in the illustration. Recall that a statement of shareholders' equity reports changes that occur in each shareholders' equity account starting with the beginning balances at the earliest year reported. So if retained earnings is one of the accounts whose balance requires adjustment due to a change in accounting principle, and it usually is, we must adjust the beginning balance of retained earnings for the earliest period reported in the comparative statements of shareholders' equity. The amount of the revision is the cumulative effect of the change in years prior to that date. Air Parts will revise its 2014 beginning retained earnings since that's the earliest year in its comparative statements. That balance had been reported in prior statements as $700 million. If FIFO had been used for inventory rather than LIFO, that amount would have been higher by $180 million, as calculated in the previous illustration. The disclosure note retaining to the inventory change should point out the amount of the adjustment. The January 1st, 2014 retained earnings balance reported in the comparative statements of shareholders' equity in the illustration have been adjusted from $700 million to $880 million. Besides reporting revised amounts in the comparative financial statements, Air Parts must also adjust the book balances of affected accounts. It does so by creating a journal entry to change those balances from their current amounts from using LIFO to what those balances would have been had they been using the newly adopted method FIFO. As discussed in the previous section, differences in cost of goods sold and income are reflected in retained earnings, as are the income tax effects of changes in income. So, the journal entry updates inventory, retained earnings, and income tax liability for revisions resulting from the differences in the LIFO and FIFO methods prior to the switch, pre-2016. Repeating a portion of the calculation we made in the earlier illustration, we determined the difference in the cost of goods sold and therefore the inventory. The $400 million cumulative difference in cost of goods sold is also the difference between the balance in inventory and what the balance would have been if the FIFO method rather than LIFO had been used before 2016. Inventory must be increased by that amount. Retained earnings must be increased also, but by only 60% of the amount because income taxes would have been higher by 40% of the change in pre-tax income. Notice that income tax effects reflected in the income tax payable account. The reason is that, unlike other accounting method changes, the Internal Revenue Code requires that inventory costing method used for tax purposes must be the same as used for financial reporting. For that reason, the tax code allows retrospective change in inventory method, but then requires that taxes saved previously, $160 million in this case, from having used other inventory method must now be repaid. However, taxpayers are given up to 6 years to pay the tax due. As a result, this liability has both a current portion payable within 1 year and a non-current portion payable after 1 year, but it is not a deferred tax liability. To achieve consistency, comparability, accounting choices should be consistently followed from year to year. Any change then requires that the new method be justified as clearly more appropriate. In the first set of financial statements after the change, a disclosure note is needed to provide that justification. The note also should point out that comparative information has been revised, or that the retrospective revision has not been made because it is impractical, and the report any per share amounts affected in the current period, and all prior periods presented. Disclosures of a recent change by Abercrombie and Fitch in a recent annual report provides us the example shown in the illustration. Concept check. Although we report voluntary changes in accounting principles retrospectively, it is not always practicable or appropriate to do so. Some changes in principle, insufficient information is available from retrospective application to be practicable. Revising balances in prior years means knowing what those balances should be. But suppose we were switching from FIFO method of inventory costing to the LIFO method. Recall from your study of inventory costing methods that the LIFO inventory consists of layers added in prior years at costs existing in those years. If another method had been used, though, the company likely hasn't kept track of those costs, so accounting records of prior years usually are inadequate to report the change retrospectively. In that case, a company changing to LIFO usually reports the change prospectively, and the beginning inventory in the year of LIFO method is adopted becomes the base year inventory for all future LIFO calculations. A disclosure note should indicate the reasons why retrospective application was impractical. Prospective changes usually are accounted for as at the beginning of the year of change. When Books A Million adopted the LIFO cost flow assumption for valuing its inventories, the change was reported in a disclosure note as shown in the illustration. A company may have some, but not all, the information it needs to account for change retrospectively. If it is impractical to adjust each year reported, the change is applied retrospectively as the earliest year practical. For instance, let's say a company changes to the LIFO inventory method effective as of the beginning of 2016. It has information that would allow it to revise all assets and liabilities on the basis of the newly adopted method for 2015 in its comparative statements, but not for 2014. In that case, the company should report 2015 statement amounts revised and 2016 statement amounts reported without restatement for the first time based on LIFO, but not revise the 2014 numbers. Then account balances should be retrospectively adjusted at the beginning of 2015 since that's the earliest date practicable to do so. Another possibility is that the company doesn't have the information necessary to retrospectively adjust retained earnings, but does have information that would allow it to revise all assets and liability for one or more specific years. Let's say the records of inventory purchases and sales are not available for some previous years, which would have allowed it to determine the cumulative effect of applying this change to LIFO retrospectively. However, it does have all the information necessary to apply LIFO method on a prospective basis beginning, say, in 2014. In that case, the company should report numbers for the years beginning in 2014 as if it had carried forward the 2013 ending balance in inventory, measured on the previous inventory costing basis, and then began applying LIFO as of January 1st, 2014. Of course, there would be no adjustment to retained earnings for the cumulative income effect of not using LIFO prior to that. If full retrospective accounting isn't possible, then the new method is applied prospectively beginning in the earliest years practicable. Concept check. Another exception to the retrospective application of voluntary changes in accounting principle is when authoritative literature requires prospective application for specific changes in accounting methods. For instance, for a change from the equity method to another method of accounting for long-term investments, GAAP requires the prospective application of the new method. Recall from Chapter 12 that when investors' level of influence changes, it may be necessary to change from the equity method to another method. This could happen, for instance, if a sale of shares caused the investor's ownership interest to fall from, say, 25% to 15%, resulting in the equity method no longer being appropriate. When this situation happens, no adjustment is made to the remaining book value, sometimes called carrying value or carrying amount of the investment. Instead, the equity method is simply discontinued and the new method applied from there on. The balance in the investment account when the equity method is discontinued would serve as the new cost basis for writing the investment up or down to fair value on the next set of financial statements. A change in depreciation methods is considered to be an accounting estimate that is achieved by a change in accounting principle. As a result, we account for such a change prospectively, precisely the way we account for changes in estimates. You've encountered many instances during your study of accounting in which it is necessary to make estimates of uncertain future events. Depreciation, for example, entails estimates not only of the useful lives of depreciation assets, but their anticipated residual values as well. Anticipating uncollectible accounts receivable, predicting warranty expenses, amortizing intangible assets, and making accrual assumptions for pension benefits are but a few of the accounting tasks that require estimates. Accordingly, estimates are an inherent aspect of accounting. Unfortunately, though, estimates routinely turn out to be wrong, no matter how carefully known the facts are considered and forecasts are prepared. New information and experience frequently force the revision of estimates. Of course, if the original estimate was based on erroneous information or calculations, or was not made in good faith, and the revision of that estimate constitutes the correction of an error, revisions are viewed as a natural consequence of making estimates. Changes in accounting estimates are accounted for prospectively. When a company revises its previous estimate, prior financial statements are not revised. Instead, the company merely incorporates the new estimate in any related accounting determinations from then on. So it usually will affect some aspect of both the balance sheet and the income statement of the current period and future periods. A disclosure note should describe the effect of a change in estimate or income from a continuing operation, net income, and related per share amounts for the current period. A change in estimate is reflected in the financial statements of the current period and future periods. When Owens Corning Fiberglass revised estimates of the useful lives of some of its depreciable assets, the change was disclosed in its annual report as shown in the illustration. An example of another change in estimate is provided by this illustration. It is given in the illustration, but the Universal Semiconductors estimates warranty expense as 2% of sales. After a review during 2016, Universal determined that 3% of sales is a more realistic estimate of its payment experience. Sales in 2016 are $300 million. The effective income tax rate is 40%. No account balances were adjusted. The cumulative effect of the estimate change is not reported in current income. Rather, in 2016 and later years, the adjusting entry to record warranty expense simply will reflect the new percentage. The after-tax effect of the change in estimate is a $1.8 million. 300 million times 3% minus 2% equals 3 million, less 40% of 3 million, assuming 100 million outstanding shares of common stock. The effect is described in a disclosure note to the financial statements as set forth in the slide. For instance, suppose Universal Semiconductors originally chose an accelerated depreciation method because it expected greater benefits in the earlier years of the asset's life. Then 2 years later, when it became apparent that the remaining benefits would be realized approximately evenly over the remaining useful life, Universal Semiconductor switched to straight-line depreciation. Even though the company is changing its depreciation method, it is doing so to reflect changes in estimates of future benefits. As a result, we report the change in depreciation method as a change in estimates rather than a change in accounting principle. For this reason, a company reports change in depreciation method, say to straight line, prospectively. Previous financial statements are not revised. Instead, the company simply employs the straight-line method from then on. The undepreciated cost remaining in the time of the change would be depreciated straight line over the remaining useful life. The illustration provides an example. A change in depreciation method is considered a change in accounting estimate resulting from change in accounting principle. So Universal Semiconductors reports a change prospectively. Previous financial statements are not revised. Instead, the company simply employs the straight-line method from 2016 on. The undepreciated cost remaining at the time of the change of depreciation straight line over the remaining useful life. Is a change in depreciation method a change in accounting principle, or is it a change in estimate? As we've seen, it's both. Even though it's considered to reflect a change in accounting estimate and accounted for as such, a change to a new depreciation method requires the company to justify the new method as being preferable to the previous method. Just as for any other change in principle, a disclosure note should justify that the change is preferable and describe the effect of the change on any financial statement line items and per share amounts affected in the periods reported. In practice, the situation arises infrequently. Most companies changing depreciation methods do not apply the change to existing assets, but instead to assets placed in service after that date. In those cases, of course, the new method simply applied prospectively as shown in the illustration. Sometimes it's not easy to distinguish between a change in principle and a change in estimate. For example, if a company begins to capitalize rather than expense the cost of tools because their benefits beyond 1 year becomes apparent. The change could be construed as either a change in principal or a change in estimate life of the asset. When the distinction is not possible, the change should be treated as a change in estimate. This treatment is also appropriate when both a change in principal and a change in estimate occur simultaneously. When it's not possible to distinguish between a change in principal and a change in estimate, the change should be treated as a change in estimate. Concept check. Concept check. Concept check. A reporting entity can be a single company or it can be a group of companies that reports a single set of financial statements. For example, the consolidated financial statements of PepsiCo Inc. report the financial position and results of operations not only for the parent company but also its subsidiaries, which include Frito-Lay and Gatorade. A change in reporting entity occurs as a result of 1. Presenting consolidated financial statements in place of statements of individual companies, or 2. Changing specific companies that constitute the group for which consolidated or combined statements are prepared. Some changes in reporting entity are as a result of changes in accounting rules. For example, companies like Ford, General Motors, and General Electric must consolidate their manufacturing operations with their financial subsidiaries, creating a new entity that includes them both. For those changes in entity, the prior period financial statements that are presented for comparative purposes must be restated to appear as if the company entity existed in those periods. However, the more frequent change in entity occurs when one company acquires another one. In those circumstances, the financial statements of the acquirer include the acquiree as of the date of acquisition, and the acquiree's prior period financial statements that are presented for comparative purposes are not restated. This makes it difficult to make year-to-year comparisons for a company that frequently acquires other companies. Acquiring companies are required to provide a footnote that presents key financial statements information as if the acquisition had occurred before the beginning of the previous year. At a minimum, the supplemental pro forma information should display revenue, income from continuing operations, net income, and earnings per share. A change in reporting entity is reported by recasting all previous periods' financial statements as if the new reporting entity existed in those periods. In the first set of financial statements after the change, a disclosure note should describe the nature of the change and the reason it occurred. Also, the effect on the change of that income from continuing operations. The related per share amounts should be indicated for all periods presented. These disclosures aren't necessarily subsequent financial statements. Hartford Life Insurance Company, a financial services company, changed the composition of its reporting entity and described it in the way as of the illustration. The correction of an error is not actually an accounting change, but is accounted for similarly. In fact, it's accounted for retrospectively like a change in reporting entity and most changes in accounting principle. More specifically, previous year's financial statements were incorrect. As a result of the error, are retrospectively restated to reflect the correction, and of course, any account balances that are incorrect as a result of the error are connected to a journal entry if retained earnings is one of the incorrect accounts. The correction is reported as a prior period adjustment to the beginning balance in Statement of Shareholders' Equity or Statement of Retained Earnings if that's presented instead, and is for accounting changes. A disclosure note is needed to describe the nature of the error and the impact on its correction on operations. We discuss the correction of error more in detail in Part B of this chapter, but first let's compare two approaches to reporting accounting changes and error corrections through the illustration. As we discussed earlier, most changes in accounting principle, change in reporting entity, and corrections of errors are accounted for retrospectively, whereas a change in estimate, including changes in depreciation method, changes in accounting principle when retrospective application is impractical, and changes in accounting principle when prospective application is mandated or accounted for prospectively. A comparison of accounting treatments is provided by this illustration. Nobody's perfect. People make mistakes, even accountants. When errors are discovered, they should be corrected. The illustration describes the steps to be taken to correct an error, if the effect of an error is material. Before we see these steps applied to the correction of an error, one of the steps requires elaboration. As discussed in Chapter 4, the correction of errors is the situation that creates prior period adjustments. A prior period adjustment refers to an addition or reduction in the beginning retained earnings balance and Statement of Shareholders' Equity. The retrospective approach is used for the correction of errors. The correction of an error is treated as per the prior period adjustment. In earlier chapter, we saw that the Statement of Shareholders' Equity is the most commonly used way to report the events that cause components of shareholders' equity to change during a particular reporting period. Some companies, though, choose to report the change that occurs in the balance of retained earnings separately in a statement of retained earnings. When it is discovered that the ending balance of retained earnings in the period prior to the discovery of the error was incorrect as a result of that error, the following the balance must be corrected when it appears as the beginning balance the following year. However, simply reporting a corrected amount might cause misunderstanding for someone familiar with the previously reported amount. Explicitly reporting a prior period adjustment on the statement itself avoids the confusion. A statement of retained earnings reports the events that cause changes in retained earnings. Now suppose that 2016 it's discovered that the error in 2014 caused that year's net income to be overstated by $20,000. It should have been $330,000. This means retained earnings in both years were overstated because comparative financial statements are presented, and because the current year is the year in which the error was discovered, the prior year would include a prior period adjustment. The incorrect balance previously reported is corrected by the prior period adjustment. At least 2 years, as in our example, and often 3-year statements are reported in comparative financial statements. The prior period adjustment is applied at the beginning of the retained earnings for the year following the error, or for the earliest year being reported in the comparative financial statements. When the error occurs prior to the earliest year presented. Now let's discuss the procedures to correct errors in the context of variety of the most common types of errors. Since there are literally thousands of possibilities, it's not practical to describe every error in every stage of its discovery. However, by applying the process to the various situations, you should become sufficiently comfortable with the process that you could apply it to whatever situation you might encounter. As we study these examples, be sure to notice that it's significantly more complicated to deal with an error if A, it is affected net income in the reporting period, and B, which it occurred and is not discovered until a later period. You shouldn't try to memorize how specific errors are corrected. You should learn the process needed to analyze whether the errors you thought should be corrected. In accounting, error is made and discovered in the same accounting period. The original erroneous entry should be simply reversed and the appropriate entry recorded. The possibilities are limitless. Let's look at one in the illustration. Maintenance expense account is credited for $3 million. Entry reversed as it was wrongly recorded as cash payment for maintenance expense. Next, the correct entry is recorded by debiting equipment account and crediting cash account for $3 million. Note, these entities can, of course, be combined. If an error did not affect net income in the year it occurred, it is relatively easy to correct. Examples are incorrectly recording salaries payable as accounts payable, recording the loss as an expense, or classifying a cash flow as an investing activity rather than a financing activity on the statement of cash flows. A disclosure note in the 2013 financial statements of Barnes & Noble reported in the illustration provides an example. The next illustration provides another. Concept check. This illustration provides an example of an error affecting previous financial statements but not net income. MDS Transportation incorrectly recorded a $2 million note receivable as an accounts receivable. The error was discovered a year later. Therefore, to correct incorrect accounts, note receivable was debited and accounts receivable was credited for $2 million. Remember, this is the first step to correct an error. Second step, when the reported comparative purposes, the current year's annual report, last year's balance sheet would be restated to report the note as it should have been reported last year. Third step, since last year's net income was not affected by the error, the balance in the retained earnings was not incorrect, so no prior period adjustment to that account is necessary. Fourth step, a disclosure note would describe the nature of the error, but these would be no impact on net income, income from continuing operations, and incomes for earnings per share to report. Most errors affect net income in some way. When they do, they affect the balance sheet as well. Both statements must be retrospectively stated. The statement of cash flows sometimes is affected too. As with any error, all incorrect account balances must be corrected. Because these errors affect income, one of the balances that will require correction is retained earnings. Complicating matters, income taxes often are affected by income errors. In those cases, amended tax returns prepared either to pay additional taxes or to claim tax refund for taxes overpaid. In the illustration, except as indicated, we ignore tax effects of the errors and their correction to allow us to focus on the errors themselves rather than their tax aspects. In 2016, internal auditors discovered that Seidman Distribution Inc. had debited an expense account for the $7 million cost of sorting equipment purchased at the beginning of 2014. The equipment's useful life was expected to be 5 years with no residual value. Straight-line depreciation is used by Seidman. Sometimes the analysis is easier if you recreate the entries actually recorded incorrectly and those that would have been recorded if the error hadn't occurred, and then compare them. This analysis is described in the slide. During the 2-year period, depreciation expense was understated by $2.8 million, but other expenses were overstated by $7 million, so net income during the period was understated by $4.2 million. This means retained earnings is currently understated by that amount. Accumulated depreciation is understated by $2.8 million. A journal entry is posted to correct the incorrect accounts. Equipment account is credited for $7 million purchased at the beginning of the year. Since depreciation expense was understated by $2.8 million, accumulated depreciation account is credited for $2.8 million, and the difference of $4.2 million, 7 minus 2.8, credited to the retained earnings account. Step 2. The 2014 financial statements that were incorrect as a result of the error and retrospectively related to the report, the equipment acquired, and to reflect the correct amount of depreciation expense and accumulated depreciation, assuming both statements, and reported again for comparative purposes in the 2016 annual report. Step 3. Because retained earnings is one of the accounts that is incorrect as a result of the error, a correction for that account of $4.2 million is reported as a prior period adjustment to the 2016 beginning retained earnings balance in Seidman's comparative financial statements of shareholders' equity. A correction would be made also to the 2015 beginning retained earnings account balance. This prior period adjustment, though, would be for the pre-2015 difference, $7 million minus $1.4 million of 5.6. If 2014 statements are to be included in the comparative report, no adjustment would be necessary for that period because the error didn't occur until the beginning of 2014. Step 4. Also, a disclosure note accompanying Seidman's 2016 financial statements should describe the nature of the error and the impact on its correction on each year's net income, understated by $5.6 million in 2014 and overstated by $1.4 million in 2015. Income from our continuing operations, the same as net income, and earnings per share. The effect of most errors is different depending on whether the error is discovered. For example, if the error in the illustration is not discovered until 2017 rather than 2016, accumulated depreciation would be understated by another $1.4 million, or a total of $4.2 million. If not discovered in 2019 or after, no correcting at all would be needed. By then, the sum of the omitted depreciation amounts, $1.4 million, 3.5 years, would be equal to the expense incorrectly recorded in 2014, $7 million. So the retained earnings balance would be the same as if the error never had occurred. Also, the asset may have been disposed of. if the useful life estimate was correct, so neither of the equipment or accumulated depreciation would need to be recorded. Of course, any statements of prior years that were affected and reported again in comparative statements still would be restated, and the disclosure note would describe the error. Most errors, in fact, eventually self-correct. An example of an uncommon instance which an error never self-corrects would be an expense account debited for the cost of land, because land doesn't depreciate. The error would continue until the land is sold. Concept check. Some errors correct themselves the following year. For instance, if a company's ending inventory is incorrectly counted or otherwise misstated, the income statement would be in error for the year of the error and the following year. But the balance sheet would be incorrect only for the year the error occurs. After that, all account balances will be correct. This is demonstrated in the illustration. When analyzing inventory errors, other errors that affect cost of goods sold, you might find it helpful to visualize the determination of cost of goods sold, net income, and retained earnings. A journal entry posting a incorrect account. If the errors discovered in 2015 and the 2014 financial statements that were incorrect as a result of the error are retrospectively restated to correct the inventory amounts, cost of goods sold, and retained earnings when those statements are reported again for comparative purposes in 2015 annual report. If the error is discovered in 2016, the 2015 financial statements also are retrospectively restated to reflect the correct inventory amounts and cost of goods sold. Retained earnings would not require adjustment, even though no correcting entry would be needed from that point. Because retained earnings is one of those accounts incorrect for the result of error, the correction to that error is reported as a prior period adjustment to the 2015 beginning retained earnings balance in Overseas Statement of Shareholders' Equity. Of course, no prior period adjustment is needed if the error isn't discovered until 2017 or later. Step 4. Also, a disclosure note in Overseas Annual Report should describe the nature of the error and the impact of its correction on each year's net income, understated by $1 million in 2014, overstated by $1 million in 2015. Income from continuing operations, the same as net income, and earnings per share. Other error corrections that benefit from a similar analysis are the overstatement of ending inventory, the overstatement or understatement of beginning inventory, and errors in recording merchandise purchases or returns. An error also would occur if a revenue or expense account is recorded in the wrong accounting period. The illustration offers an example. First, an analysis given in the illustration's 2015 sales, revenue was incorrectly recorded as of 2016. So 2015 net income was understated. Retained earnings is currently understated in 2016. 2016 sales revenue is overstated. Note, if the sales revenue had not been recorded at all, the correcting entry would include a debit to accounts receivable rather than sales revenue. Step 1. A journal entry is posted to record the incorrect accounts. Since 2015 sales revenue was incorrectly recorded in 2016, leading to understatement in 2016. Sales revenue account is debited and retained earnings account is credited for $3,000. Step 2. The 2015 financial statements that were incorrect as a result of the error are retrospectively restated to reflect the correct amount in sales revenue and accounts receivable when those statements are reported again for comparative purposes in 2016 annual report. Step 3. Because retained earnings is one of the accounts incorrect as a result of the error, the correction to that account is reported as a prior period adjustment to the 2015 beginning retained earnings balance in the general paper's comparative statements of shareholders' equity. Step 4. Also, a disclosure note in General Paper's 2016 annual report should describe the nature of the error and the impact of its correction on each year's net income. $3,000 in 2015, income from continuing operations $3,000 in 2015, and earnings per share. The illustration shows how Benihana Inc. corrected its financial statements for having incorrectly expensed leasehold improvements and assets on leased property in past years. Benihana was one of hundreds of firms making similar corrections in 2007 following a Securities and Exchange Commission letter on February 7, 2007, urging companies to follow long-standing accounting standards in this area. As the note indicates, Benihana's previous earnings had been overstated by $2.2 million as a result of the error, and the balance is retained earnings accordingly. Decreased in the correcting adjust journal entry. At about the same time, McDonald's Corp. Recorded a similar charge in $139 million. Concept check. In previous chapters, we discussed the possibility that U.S. companies will be required or may choose to switch from U.S. GAAP to International Financial Reporting Standards. When a company moves for the first time from U.S. GAAP to IFRS, it should follow the requirements of IFRS number 1, First Time Adoption of International Financial Reporting Standards. The basic requirement is full retrospective application of IFRS for the company's first IFRS financial statements. A company's first IFRS financial statements must include at least 3 balance sheets and 2 of each of the other financial statements. For instance, if the company's first IFRS reporting period is for the year ending December 31, 2018, the first balance sheet would be the opening balance sheet of 2017, which is the ending balance sheet of 2016. The other 2 balance sheets and each of the other statements, income statement, statement of comprehensive income, statement of cash flows, statements of changes in equity, are for the years ended December 31, 2017 and December 31, 2018. The date of transition to IFRS is the date of the opening of the balance sheet, January 1, 2017. In this situation, first-time application of IFRS entails recording some assets and liabilities not permitted under U.S. GAAP, such as some provisioning, contingent liabilities, permitted under IFRS but not U.S. GAAP. 2. Not recording or de-recording some assets and liabilities, for example, an intangible asset for research expenditures permitted under U.S. GAAP but not IFRS. 3. Reclassifying items that are classified differently under the 2 sets of standards. For instance, reclassifying some preferred shares from shareholders' equity classification under U.S. GAAP to liability classification under IFRS. 4. Providing disclosures in notes in the financial statements required under IFRS but not under U.S. GAAP. 5. Providing extensive disclosures to explain how the transition to IFRS affects the company's financial position, financial performance, and cash flows. These disclosures include A. Providing explanations of material adjustments to the balance sheet, income statement, and cash flow statement, and B. Reconciliations of equity and total comprehensive income reported under previous GAAP to equity under IFRS. Although basic requirements is full retrospective application of IFRS, these are several optional exemptions and 5 mandatory exceptions to the requirement for retrospective application. The exemptions are designed to allow companies to avoid excessive costs or difficulties expected for retrospective application of certain standards. For example, if an adopter chooses to report assets such as property, plant, and equipment at fair value as permitted by IFRS, it can measure that fair value at the opening IFRS balance sheet date rather than having to do so retrospectively. Fair value becomes the deemed cost going forward under IFRS. Also consistent with the fair value option under IFRS, fair value is permissible for intangible assets only if they are traded in an active market. The optional examples relate to business combinations. B. Fair value or revaluation is deemed cost for property, plant, and equipment and other assets. C. Employee benefits. D. Cumulative translation differences. E. Compound financial instruments. F. Assets and liabilities of subsidiaries. G. Associates and joint ventures. H. Designation of previously recognized financial instruments. I. Share-based payment transactions. J. Insurance contracts. K. Decommissioning liabilities. L. Arrangements containing leases. M. Fair value measurement or no active market accounting instruments in full bloom. Service concessions and arrangements, and O. Borrowing costs. Concept check. The FASB and the International Accounting Standards Board have a continuing commitment to converge their accounting standards. As part of the short-term convergence efforts, they've identified how companies report accounting changes as an area in which the FASB could improve its guidance by converging it with the provisions of IAS number 8, Accounting Policies, Changes in Accounting Estimates, and Errors. The product of this effect was a new FASB guidance issued in 2005. Few differences remain, so it's unlikely we will see much change in this area. Accounting changes and error corrections. U.S. GAAP and international standards are largely converged regarding accounting changes and error corrections, but one difference concerns error corrections. When correcting errors in previously issued financial statements, IFRS IAS number 8 permits the effect of the error to be reported in the current period if it's not considered practicable to report it retrospectively, as is required by U.S. GAAP. The 5 exceptions cover areas which retrospective application of IFRS is considered inappropriate and relate to derecognition of financial assets and financial liabilities, mandatory, hedge accounting, mandatory, non-controlling interests, mandatory, full cost oil and gas assets, optional, determining whether an arrangement contains a lease, mandatory. Almost all adjustments arising from the first application of IFRS are against opening retained earnings at the first period that is presented on an IFRS basis. This is the end of Chapter 20.